Is it still all bad for China's economy, or might we actually see some rays of sunshine coming out as the latest economic data crosses the wires? That's the question we are going to ask ourselves today. Of course, in the context of what's happening in the global economy, which is worryingly inching toward recession, a Federal Reserve that seems to be intent on whistling past the graveyard, and inflation data that, at least at the very nominal headline level, supports their case. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. And we are going to, as ever, balance a conversation about the two main things happening in global markets at this point and driving things at this point. The give and take between a Fed that doesn't want to help in a premature way a global economy that is already near standstill, and a China that's very actively pushing it past standstill and into a global recession kind of state. So we begin this time around, having been focused on the Fed all week with CPI and FOMC minutes, on the growth side of things, because we have a big swath of Chinese economic data due to cross the wires. First up, CPI. And here things look about as anemic as they have for months now. The headline inflation rate here expected to tick up a hair to 0.2%. Not exactly the world's most encouraging result. The previous number, as we say, mildly positive. The one before that, negative 0.3. The one before that, 0.2. We haven't had inflation over 1% in China since February. So clearly the situation here, very anemic indeed. Another contraction as well for wholesale prices, albeit at a slightly diminished rate, down 2.4%. So certainly off the worst of it at negative 5.4, but nevertheless negative. This is the opposite issue that we have in the US and Europe, where of course inflation is still high and central banks are trying to fight it. Here inflation is very clearly too low. And we have heard from Chinese officialdom that this is mostly due to food prices and year-on-year adjustments. When you look at, say, September's numbers are going to be up only 0.2%, but of course China was in lockdowns a year ago, so food prices, officials might argue, were elevated, and so you would have this sort of paltry year-on-year change, but that kind of an explanation rings hollow. Because when you look at GDP and you look at economy-wide measures, already in the second quarter of this year, we had the very unusual situation that real GDP exceeded nominal GDP. And that's to the tune of 1.5%. Now, how do you get from real to nominal GDP and then back again? Well, you take nominal GDP and you subtract from it the influence of inflation, because what you're trying to say is, here is the value of all the goods and services produced in the economy. How do you get that value? You get the number of stuff and you multiply it by the cost, the value. But if the price itself is going up, that tells you that you might have a bigger GDP than actually the stuff warrants. That wouldn't exactly be a like-for-like comparison as you looked at how your economy is doing from month to month, quarter to quarter, year to year. Because the influence of inflation might either obscure or amplify growth in a way that is misleading. Here we have the opposite. So we take nominal GDP, we subtract from it inflation, we get to real. But what happens if real is above nominal? It means that whatever we're subtracting from nominal is negative. And here it's negative to a staggering extent. 1.5% is a huge gap, considering it's 1.5% of the world's second largest economy. So what this is telling us is that demand is essentially non-existent in China. That, and it's not difficult to understand why if we consider that inflation comes from economic activity, there being demand to buy things, to spend money on things, goods and services. The supply of goods and services then meeting that demand, and the more there is demand, given supply at any given time, the higher the price goes, because buyers are competing, and there is an increase in the price because that's the way that they compete. Whoever is willing to pay more gets that thing. This is that dynamic in reverse. Nobody wants to buy things, and obviously we're painting with a very broad brush here, generalizing, but very few people want to buy things, and so things go on discount to try to induce them. Hence, the price is falling. And here, it is falling by a giant margin. So the story that comes out of CPI data here, to the extent that it extends this narrative, speaks to an economy that's holding on, barely not flatlining at this point. It gets further reinforcement from the trade report that's due to come out today, where we're supposed to get the 5th consecutive month that imports and exports fall together. So this would tell us not only is there a loss of export demand, but there's a loss of domestic demand. Now, surely some of this fall in imports and fall in exports are tied at the hip, because China is fundamentally, in terms of its role in the global economy, a value-add supercenter. Tons and tons and tons and tons of imported inputs come in, be they raw materials or semi-finished goods. China then applies its, until recently, vast labor resources to either finish the goods or get them to some sort of a prefabrication stage that's the one after the one that they arrived in, and then re-exports those things as either more finished or finished goods, mainly to the US and Western Europe, but also markets all over the world. So at least some of this collapse in imports isn't just weak domestic demand at a consumer level or at a consumption in China level, but is also linked because if export demand is down, then you need fewer inputs to make the exports that are less in demand. And so there is a bit of a overlap here. But nevertheless, the picture looks dire, because if most of the population is employed doing this value-add stuff, and if that's a huge part of the economy, which of course it is, in so much as it characterizes China's main business model outside of real estate, which we'll touch on in just a second, the situation looks dire any way you slice it. Demand is fizzling. in large part, this is because of China's belated opening from COVID. As we can see here, not only did the main customer base in the US and the Eurozone start to unwind COVID restrictions and reopen sooner, but their spikes in catch-up growth after COVID crested some 18 months before China even began to rejoin the global economy. And that's, of course, because there was lingering stimulus, there was the dividend from reopening and letting people back out. And we saw some of that same dividend in China as well. We can see once the reopening occurs, you do have a bit of a pickup in activity here. But it proves very shallow, crests by March, mainly as services do their catch-up bit from people moving around the country for the first time in a long time, being able to go to restaurants, being able to go to outdoor events for the first time in a long time. So you get a bit of a pop, but it very quickly subsides. That post-COVID catch-up right here was already over and very much going in the opposite direction, both because growth was normalizing and because central banks were already starting to aggressively hike interest rates in the face of inflation. This occurs over a year before China even comes back online or tries to. And so by then, supply chains had already diversified or were very much on their way to diversifying away from China. And of course, the level of demand that might have been expected is just not there because growth was already slowing. In fact, we can see here in the case of Europe, we're already below 50 on this composite PMI reading, suggesting Europe's economy is contracting and has been contracting for 3 months already. And the US economy is basically hugging the 50 level and it's near standstill. So this is the world into which China reopened. Not surprisingly, there isn't a bunch of end demand on the other end of it. In fact, we can see that even as we've seen a slowdown in overall global volumes, this is basically measured as the sum of global exports and imports looked at year on year in the lines there, and China's share of global volumes in the yellow bars. We can see here that China's share of global cross-border activity has come down from 15 to less than 13%. That's a decline of over 2%, multiplied by global trade volumes, all of global trade. So needless to say, this is an astronomical difference. And what we can see here is that as we get a slowdown in global activity, thanks mainly to central banks, and of course that same normalization in demand that we just saw here in the PMI numbers starting right around the middle of 2021. You can see that same thing start to happen around here. You see a slowdown in global growth, but for the most part, the slowdown in China has exceeded it. And the drop has been harder. So the situation is very dire indeed, because it looks like the main engine of how China has positioned itself to grow in the global economy is very clearly working in reverse. Then, of course, as promised, there is the housing market. Now, housing is a huge part of China's economy. It is the other way that China has managed to grow because it was so successful as a value-add center on the trade side. A lot of that economic optimism went into a capacity to borrow with relative impunity, and thankfully for at least the current situation, mainly within itself, but to some extent from global markets, but because China is relatively closed off from global capital flows, at least that part of it is somewhat slowed as capital runs away. But nevertheless, China's success enabled it to be a relatively credible borrower. And so there was a tremendous amount of borrowed money that was plowed into a huge nationwide infrastructure build out. Cities, airports, rail, highways, residential, all of it, mainly leveraged and mainly underpinned because housing is seen as the quintessential part of local portfolios. And so a lot of it is underwritten domestically by local investment. What that also means is that there's a tremendous exposure to housing for local investors at every level, big and small, from institutions to the smallest retail individuals. And so what this loss of demand has meant is we can see here again from about 2019 onward, there's a cresting, and then of course with COVID, a rapid acceleration in a decline in housing because so much of it is underwritten by local demand, both investment demand and actual demand for the housing itself. And so this has been an absolute wrecking ball because that demand is what fueled the other main growth engine in China. Building all of this housing was a huge employer. And at this point, tons of that demand, clearly with the decline in price, has evaporated. And so that activity, which might have been, were this still as robust as it was a few years back, might have helped to at least paper over some of the weakness on the trade side. Well, that's gone. And so we now have not only weak external, but very much weak internal demand as the dire situation in the housing market reveals. So, what are we to make of this? Well, Chinese authorities seem, for their part, at least, reluctant to do very much about it in any kind of a meaningful way. Here's the implied policy curve at the start of reopening. You can see the markets were exuberantly optimistic about what would happen to Chinese rates because from the start of reopening, the policy curve looks like rates are going to have to go up in a hurry with steep incline, ostensibly because the economy is surging. Well, since then, we've had a big 10 basis points in rate cuts. That's next to nothing, considering how much easing the Western economies had to do to offset their COVID deficit. We can see the curve has aggressively flattened, but it's also not really pointing lower. It's not really saying that the markets truly anticipate that Beijing is going to do more here. If we look at the flow of loans and financing, we can see that indeed the situation looks fairly constrained. There was a bit of a pop in the recent loan data. It helpfully turned fractionally positive, but the trend is actually down and the numbers are very small. So a surge in liquidity, even as the central bank attempts to do liquidity injections and reduce reserve requirements for banks and alter incentives for home buying to try to get more activity going there. Even as all of that occurs, credit growth is pitiful, at least for now. Looking at the measure of Chinese financial conditions from Citigroup really makes the point. We can see here that all year, financial conditions have remained restrictive. In fact, the last time we have to go to financial conditions being on average looser and somewhat accommodative is back at the start of 2022, over a year ago. So for all of the little measures that Chinese authorities have tried, it looks like they're not really making a concerted impact, at least from a monetary stimulus perspective, to turn this ship around. As for the fiscal side, we've heard now repeated commentary from Chinese President Xi Jinping saying what China now wants is high quality growth as opposed to low quality growth, implying that they're not going to attempt to juice the economy with fiscal spending. They're not going to attempt to try to juice the economy by levering up the property sector even more. So it seems like China might actually be settling into a period of anemic growth knowingly, and has decided that this is okay, that they just need to sit down and not grow very much for a while. Now, this, of course, presents a very substantial risk for global growth because China is one of the three major engines of global economic activity. Not surprising, frankly, when you consider that it is the world's second largest economy and taken collectively about 15% of global GDP before you account for all of the economies that depend on it. Like, say, most of the economies of Southeast Asia, a lot of the commodity exporters in Africa and Latin America, Australia, New Zealand. All of these economies look to China as its main export market, or at least top two. And so the influence is even greater than 15% that China itself makes up. So looking at that here, this is, of course, very worrisome. The latest round of PMI numbers already told us that we are in a situation where global growth has slowed to almost nothing. At 50.5 on the composite PMI here, we are but half an index point away from standstill at 50. It's not a far stretch from there to go under 50 and end up in contractionary territory where, as we just saw, Europe already is. And then, of course, the question comes, well, how do you not get there when Europe is already where it is? China is flatlining, and Beijing doesn't seem to want to do anything about it, or at least not in size. Well, that brings you very close to a global recession, which, of course, is a dire prospect for markets. Because, of course, at the end of the day, at least when you talk about stocks, you're talking about earnings, and you do need growth in employment and spending to get earnings. So the situation looking very much like a troubled one for markets, because on the one hand, they have this global recession, and the data out of China might only make that look likelier and worse. Meanwhile, the Fed, at least as far as they're saying, doesn't seem to want to be in any kind of hurry to offer some support. We can see how that looks in markets here. There's the September FOMC. And we can see here where the Fed really makes clear its higher for longer case by way of policy expectations that essentially reduce scope for rate cuts next year by about 50 basis points. there is an attempt at a reversal, but the initial response is clearly, well, the situation is dire, so if the Fed doesn't want to give us support, that's bad, and stocks go down. There's some indication that maybe the market has already absorbed this part of it, because in the wake of NFP last Friday, we clearly saw stocks recover, even as NFP gave us a much stronger U.S. jobs market than anticipated. So one might make the argument that the Fed has already seen the markets absorb what it said, reflect it, and move on, at least until more information presents itself. But that theory will be tested if, in fact, the other side of the equation shifts. So if there's a give and take here between how bad is the economy and therefore how soon do the markets want the Fed to relent and cut, if the Fed has given them a sense of here's about where we are in terms of scope for easing, and the markets digest that and pause, if you then move the other variable in an adverse direction, well, maybe then you want even sooner cuts because you fear recession comes even closer. But just earlier today, we got CPI data that, while it wasn't anything inflationary at a Fed relevant way and in no scary sort of fashion, it nevertheless gave us inflation that was higher than expected and off the Fed's target. So the Fed is unlikely to change course in a hurry here. Meanwhile, Chinese economic data continues to underperform relative to expectations. Now, we have seen a little bit of a level shift here. We're still below zero, which means in terms of this economic surprise index that we're still surprising lower, but maybe by a lesser margin. So maybe things are getting better at face value, but not so fast. As we can see here, the expectations themselves got shifted down. And so the data has had an easier time clearing the bar. So if we see here, the bottom is mid-July and the revisions begin mid to late July. So this is still very much data that can surprise lower, all of which would amplify global recession fears, all of which would encourage markets to think the Fed might need to go sooner on some kind of a policy turn. And of course, from the Fed's perspective, they're in no kind of hurry, which would altogether amount to something of a toxic mix for stocks and for cyclical assets, be they copper, be they crude oil, be they the Australian or the Canadian dollars, and might actually be more supportive for bonds, more supportive for the dollar. Unless, of course, as we see here, the market has already turned the corner. And whether it has or not, we shall see some kind of a response in the face of this Chinese economic data that will tell us more. If the market cares, then we'll know we've not moved on. And we're perhaps witnessing an upside correction in a down move in stocks rather than some kind of a longer-term recovery. We're witnessing a pullback in the dollar recently rather than some sort of longer-lasting decline. And of course, if the market shrugs this off, much as it did NFP, well, then maybe it is clear skies in the near term. At least until the data gets even worse, or the screws tighten even harder. And that is Macro Money for today. Thanks very much for joining. As ever, we are here Monday through Thursday every week, right after overtime, a show that I co-host with Chris Vecchio, head of Futures and Forex here at tastylive, covering the day's events, trying to make sense of them and seeing perhaps what comes next. Dylan Radigan increasingly joins us for that lively conversation. I am also on with Tom and Tony for First Call on Sundays, on with Chris again on Fridays for Futures Power Hour, opining on the news and insights section of tastylive.com, and commenting occasionally on the platform formerly known as Twitter at Ilias Pivac. Thanks very much for joining. That's Macro Money for this week. I'll be on Futures Power Hour tomorrow and back with this show Monday. Have a great weekend. Take care.